that my presentation would cover all the key aspects of CARO 2020. It's actually not an amendment. CARO 2016 has been effectively replaced by CARO 2020. Applicability remains the same. We'll discuss all that as we go by. So nice that the three branches could come together, organize. Members are joining in. We are almost 40 now. Frankly, this being the topic, I'm expecting a larger crowd. Not because I need a crowd, because the exercise that we do should reach out to the maximum members. While at that, I had mailed across a PPT on CARO, a PPT on Schedule 3, revised Schedule 3, and the format, editable Word format to all the members. I hope you have received. So if there is an issue with that, you can get in touch with me, because every one of us do not have to reinvent the wheel. Everyone doing all Schedule 3 changes, a few students sitting around that, and everyone doing a CARO is not required. Some homework has been done in our office, and based on that, I had shared this templates as well as the format, Word format of CARO 2020 and Excel format in Schedule 3, revised Schedule 3. And with the caveat, with the covering note, with the caveat that user discretion is highly advised, and also that you may have to customize from case to case. So with that introduction, let us go to the topic. Once again, thank all the three branches. I've come to these branches physically during my chairmanship, and I would really love to, but now we are used to this online programs. Eventually, I think we should go for physical programs. I think Gali sir has joined it.
Yes, sir. Please.
Gali sir.
Yes, sir. Good evening. Voice breakup, sir, please.
Good evening, sir. Good evening to all the members.
I do, sir.
Good evening, sir. Good evening, sir.
Good evening.
Yeah.
Welcome to the seminar, sir. Gali sir.
Gali sir, the audit has been finalized and fees received.
Sir.
Sir, you are visible.
Yeah, you are now visible and audible. Good evening, sir.
Good evening, sir. Good evening, sir. How are you?
Good evening, sir. Good evening.
I'm good. So audit is finalized and fees has been, you are smiling, so it means that fees has also been received.
Not yet. So I'm on the same job. I'm on the same job doing CARO compilation.
Oh, really? Okay. Right, sir. Great. Over to you, sir. Over to the organizers.
Good. Sir. Yeah.
Sir, please, you can speak out, sir. Your valuable words on this occasion. Really, sir, please.
Rena?
Chepin, sir, please.
Yeah. So good evening to the speaker of the day, past chairman of SRC, CA.Jomon sir, and all the members, colleagues of the regional council and members of the branches. Good evening to each one of you. Friends, I'm very happy that CA.Jomon has pulled off time to address our members. He's extremely passionate as a speaker and is very good in corporate law. So I'm sure all of us would have a great learning from his rich experience and interaction. So I think I'll not take much time. I request Jomon sir to continue his address. Thank you very much for giving me this opportunity.
Thank you very much, sir, for joining this, sir. Thank you. Sir, please continue, sir.
Thank you. Sir.
So I was about to share the screen, right? Is it visible now, sir?
Yes, sir. Visible, sir.
So CARO 2020, as Subbarao sir rightly said, it was notified in February 2020, and everyone thought it was going to come from first 1920 financial year. It did not come, it was deferred. Then again, we thought it's going to come in 2021, deferred by one more year. Finally, it has been made effective from financial year 21-22 or accounting period starting on or after 1st April 2021. This is the coming in, or rather the arrival of CARO in brief. As he rightly said, there are 21 clauses. I have divided that into 3. New clauses, there are 7. including 2 reintroduced clauses from CARO 2003, which was dropped in 2016, has been brought back. Modi 7 modified clauses. All the 7 clauses have been retained as it is without any change. So 21 clauses. And there was a clause on managerial remuneration, whether the managerial remuneration is in accordance with 197 of the Companies Act. That has been dropped. Though we talk about 21 clauses, we have 47 subclauses, which makes it fairly lengthy and detailed. So, but the reporting responsibility, those who have gone through the CARO 2020 would appreciate that the spirit of CARO 2020, if you see, it's more from banker's angle that the whole thing has been taught. Many of the clauses seems to be wanting to protect the lenders, bankers as well as financial institutions. We are not surprised because there are a lot of NPS which are emerging, and with the COVID effect is still to fully emerge, so to come out. So with that, there will be substantially more amount of NPS, and many of the constituents, borrowers are playing around, showing non-existent stock, showing receivables which are very old and unrealizable as security and taking loan over loans. So that seems to be the spirit of CARO 2020. So is the case of the amendment to Schedule 3 also. Very detailed disclosures. Those who have started studying, you would know that aging of debtors, which is there, but now there's a different 5 column, 5 kind of slots in which it has to be classified. Creditors, trade payables, aging has to be done. Work in progress, capital work in progress, aging has to be done. Intangible assets under development, aging has to be done. Which means that they're trying to say that whatever is old, not human beings, whatever is old is not good from a financial management point of view, from a prudence point of view, from a financial strength, health point of view. So that is the overview of the order. Now, specifically, we will see which are the newly added clauses. There is a question on the point which is to be reported on transactions not recorded in the books, which have been detected during an assessment, search, or survey. That's a new point, which is there in the Schedule 3 also. The ability of the company to meet its liabilities based on the financial ratios, which is a new introduction in CARO, Schedule 3. Based on the financial ratios, your discussions with the management, analysis of current assets, current liabilities, etc., particularly financial assets, the audit has to come in whether the company will be able to meet its liabilities going into the future without much of a problem. It's a very challenging course, very demanding course. So today the auditor is required to have foresight. Till this time, we used to have the hindsight, the knowledge of the present, things which are happening. Now we have to look substantially into the future. The economic considerations, the economic environment has to be considered. For example, in the Andhra and Kerala, we have a lot of tourism projects. Some of them are stuck now. So based on that, we'll have to comment on it. CSR, section 135 was introduced as a very friendly section. But now it says that, the auditor has to report on the unspent amount. We'll come to the details. Statutory audit resignation, yes, that also has to be reported in detail. What are the reasons for resignation? What is the outcome of his discussion with the statutory auditor who resigned? And in whose place you and I came in as statutory auditors. Consolidated financial statements. If we have the auditor of the holding company, if there are some adverse remarks in the CARO of the subsidiary company, that has to be considered. He has to comment on that. Internal audit system, there's a new clause also. It has been reintroduced with some additional requirement. Whether there's internal audit system involved and whether the statutory auditor has considered the report of the internal auditors. That is a very important point. Okay. Cash loss brought back. Cash losses, whether the company has incurred cash losses during the year or in the immediately preceding year. Is the going okay? Am I audible? Is the pace okay? Can someone respond?
Okay, sir.
Yeah, thank you.
Yes, sir.
Yeah. Okay.
Sir, please increase the volume of this thing, sir. Unable to hear.
Oh, really? Okay.
Yes.
Right. How is it now, sir? Is it better?
Yeah. Yes, sir.
I hope I do not repeat. Yeah. Okay, so the summary of clauses here. 1 minute. Let me go to the full screen. I hope the full screen is visible for you. Yeah. Okay, yeah. Now, modified clauses. We have fixed assets. There are some modifications in the reporting of fixed assets. Inventory, yes, there are modifications on the procedure and coverage adopted by the management. Repayment of loans granted by the company. Company has given loans, whether their repayments are forthcoming, if not, whether corrective action is being taken. Default in a payment of dues, repayment of dues on the loans taken by the company. Reporting of frauds, 143.12, there is a new requirement. Nidhi company, there are a few points which are again been modified. And registration with the RBI under 45 IA of the RBI Act. These are the 7 modified clauses. Then retained clauses, acceptance of deposits, maintenance of cost records if applicable, loans, investment and securities and guarantees 185 and 196, application of funds raised, whether the company has supplied the funds for the purposes they have been raised. Yeah. Related party transactions, yes. Non-cash transactions with directors and payment of statutory dues. This is how I have classified into 3 blocks, totally new clauses, including 2 new introduced, 7 modified clauses, and 7 retained clauses. So we will, instead of going in the order of that, we will first deal with the new reporting requirements, that is which requires more detailed deliberation than the existing clause, which has kind of settled into our system. Now, applicability from 1st April 2021. Every company, including a foreign company, as defined in 242 of the Companies Act. Government company is not exempted, applicable to government company also. I think Delhi sir is working on the CARO report of a government company, state government enterprise. Branches, if branches are audited by a different chartered accountant than the statutory auditor, then naturally it has to be, yes, also have to issue a CARO report. CARO is not applicable to banking companies, insurance companies, Section 8 companies, 1-person companies, small company under Section 285 of the Companies Act 2030, private companies subject to conditions. Now here I need to explain the definition of a small company. 2 changes have happened. Recently the limits have been increased. A small company is a private limited company whose paid up capital does not exceed, it was 50 lakhs earlier, now it is 2 crores, and it is not or, and turnover as per the latest audit accounts does not exceed 20 crores. This is the definition of a small company. So if you're a small company falling into this definition, cumulatively satisfying both the conditions. That is why the jointer is and. Earlier it was or. You are exempt. And look at the last bullet point where I put an asterisk mark. Small company under the act shall be exempt. Small company under the act shall be exempt, even if it falls under other criteria. We'll see, because when we see the private limited company, it will become clear. Private company is exempted. If it's a holding or a subsidiary of a public company, you are in that chain, there's no exemption. You are treated as a public limited company for this purpose. Borrowing should not exceed 1 crore at any time during the year. Total revenue should not exceed 10 crores for the year. And paid up capital and reserves should not be more than 1 crore. If these conditions are satisfied, private limited companies are exempt. Just I'm expanding, this is not from this thing, but please know that Institute has come out with a beautiful guidance note, very detailed one. Some points are not very current, up to date if you very critically evaluate. But it is available online. You have to go buy CDs, you have to buy. I bought one hard copy, but some of us we still like to read the books than online reading. So fairly exhaustive. I have pulled out these definitions from there. Paid up capital includes equity and preference shares and shares forfeited. Does not include unpaid calls and share application. Reserves and surplus including capital reserve, revenue reserve, including revaluation reserve, adjusted for debit balance in the profit and loss. P&L debit balance is now shown as a bracketed item under reserves, right? So with that, automatically you'll get it from the face of the balance sheet. And therefore, that is what the clause which you have to see, apply whether it will fall under these 3 categories. Then you are exempt. But if you're a small company, you are otherwise also exempt. Now we go to the new clauses. Of the 7 clauses, we'll start with the first one on internal audit. Whether the company has an internal audit system commensurate with the size and nature of its business. A very simple, plain question, which used to be there. Okay. Now look at the new point. Whether the report of the internal auditors for the period under audit were considered by the statutory auditor, which means that ideally this clause should have been there only for internal companies for which internal audit is mandatory. Section 138 gives a list of companies based on certain threshold, certain criteria. For them, internal audit is mandatory. Many of us still do not know that. Many of the managements do not know that. But MC is also not taking any very harsh or strict action against non-compliance. But then this, once it is applicable, CARO is applicable, irrespective of size, etc., you have to report whether there's internal audit system commensurate with the size and nature of the business, whether the reports of the internal auditors have been considered. So which means that one, the internal auditor, sometimes they say that it is an internal audit. Our own people are doing. There's a separate internal audit department. Well and good, it's okay. But they should issue a report in the first place. Something like observations, an internal audit report, which should be seen, examined by the statutory auditor. Recently, we concluded one audit, which is a state government, state PSU, where we are the statutory auditors and our Babu sir, Babu Abraham sir, is internal auditor. So he had issued the reports for the 3 quarters. 4th quarter, because they wanted to complete the statutory audit in April itself. Of course, it came to May, first week of May. The last quarter internal audit was still going on. So we had a glance at the draft of the report. And based on that, we said, yes, the internal auditors' reports have been considered by us. That is how we have reported in that case. It's where applicable to that is we have to go. And we got copies of all the internal audit reports. Today, when we talk about copies, let me also tell you that the style of documentation is undergoing a major change. We don't have hard copies of this internal audit reports. They have soft copies. So our the audit team, one senior and one junior were there. And I personally supervised the audit. I was there for a couple of days. So there we had a glance of the soft copies, and then finally it is stored in the audit folder, the client's audit folder, as internal audit reports. So I think we should reduce paper substantially. Earlier on, we used to have big box file, 1, 2, 3 box files, calling working notes files or current file. Systems are slowly changing. And the new generation, the kids are more comfortable with this, online document, whatever we call it, documentation, paperless documentation. New clause 2, we had seen in the master slide, whether the company has incurred cash losses in the financial year and immediately preceding financial year. If so, state the amount of cash losses. It's not very demanding. It's very easy. Once a balance sheet and P&L are drawn, and then P&L and balance sheet are drawn, it becomes very easy for the auditor to state this amount and quantify that. Sirs, I am audible now, loud enough, clear?
Yes, sir. Clear, sir.
Okay, right. Good. I'm having a sore throat, so please bear with me. I'm sipping a cup of hot tea. Unrecorded income. Whether any transactions not recorded in the books of account have been surrendered or disclosed as income during the year in tax assessments under the Income Tax Act. If so, whether previously unrecorded income has been properly recorded in the books of account during the year. I think I'm not a tax practitioner. I do not have major tax files. And none of our clients so far haven't had any search or anything of that sort. This apparently does not confine to search in itself. In a regular assessment also, if there is a demand, based on there's an concealed income, unrecorded income has been detected for whatever reason. But majority of these cases, this will be in a search and seizure case, where, for example, everything is kind of okay, except that an FDR of 2 crores. An FDR of 2 crores in the name of the company has been found. It's a deposit receipt. Let's say Andhra Bank is not there, the merged bank, Union Bank or Canara Bank, whichever, SBI. And ideally, this should be accounted. Wherever I presented, I had a discussion with the members. So I suggested that this, maybe they accumulated, earlier on it was possible, now that's not possible, accumulated cash transferred to a director's account from there, opened on the name of the company, etc., etc. They would have somehow managed to get an FDR of 2 crores. How do we account this? FDR, fixed deposits debtor, 2 crores. To provision for taxation, ease of calculation, if you say it's 60%, provision for taxation 1.2 crores, and 0.8 has to be taken into the P&L account. As a revenue thing. As an exceptional item. this has to be established. So even if that's not done, the same point is there in Schedule 3 also. So as preparers of financial statements, the management should also see whether that has been recorded. Here, the auditor's responsibility is to check whether they have been properly recorded in the books of accounts during the year. This is one example. I thought there could be more complex examples, but assets, revenues which are detected, unearthed during a search or seizure, then once that is accepted, has to be brought into the books of accounts. Goes without saying. If it belongs to the company's assets. When a raid happens, as we call it the layman's term, the raid happens in the premise of a company. Sometimes they will do the same. Directors, all those people, major shareholders also, they can probably. So there, if the findings are there, it's not concerning the company, that is not to be taken into account. The case of a company, yes, this has to be touched. Sir, if there are some questions, we can take some questions in between, or we'll keep questions for the end.
Sir, lastly, if you can take that, flow will not be disturbed, sir.
Yeah.
I think.
Appreciate, sir. Thank you. Now, resignation of the statutory auditor. I hope some of you would remember. About 3 years back, I think it was in 1920, a lot of audit resignations in the corporate India space, in the scape of, or India Incorporated, as they say. Pricewaterhouse resigned from one of the Anil Ambani companies. I think it was Reliance Infocom or something, where they resigned. And the reason stated was strikingly, we are not able to obtain sufficient appropriate evidence to form an opinion on the financial information. This is something which we study in the first auditing, is it not? In my introduction, those who heard was mentioned that I was teaching 20 years. Yeah, that is really nice. Whatever I am today, I would attribute to the decision to take classes at the Ernakulam branch. As a much younger member way back in 1993. And we restarted classes here for all the subjects. And so there, the first class we say, the auditor should obtain sufficient appropriate evidence. There they resigned stating that there could be many reasons, management disputes, etc., etc. So here the auditor has taken into consideration, the auditor has to see, discuss with the statutory auditors, see their communication, communicate with them, and take into account the consideration, the issues, objections, or concerns raised by the outgoing auditors. The one in the box is mine. Concerns raised by the outgoing auditor in the auditor's report, and otherwise, communication before accepting engagement, discussions and communications with the TCWG, those charged with governance. Slightly at a different footing from saying management or the board of directors. Those charged with governance could be in a location, a senior operations manager in a branch where he is a topmost authority, could also be part of the TCWG and include specifically in the MRL. So this is something every one of us should take note. See, certain auditing practices, we are very passive about, very healthy auditing practice. The kind of documentation the Big Four or even the firms like GT, yesterday we had an audit committee meeting where Grant Thornton, who are acting to Walker Chandyok, LLB, as a statutory auditor, we are the internal auditors. It's a listed company. The documentation they're calling for is really painful. But I think we should also do, if not to that extent, we should do all that is possible to make our work defensible. That's the term they use. Our work should be defensible in a court of law, in a disciplinary proceeding, wherever. If there is a management dispute, we are dragged into that, yes, you should be careful. So letter of representation is a mandatory requirement under SA 580. Standard Auditing 580 is written representation. Let me take a detour for 2 minutes to explain the importance or the mandatory nature of standards audit. Till Companies Act 2013 came, SAPs or auditing standards, as they were called, auditing and assurance standards. I was fortunate to serve the IASB in 2005-06. When Maran Sir became the vice president, he co-opted me to the auditing board, assurance standard board, AASB. Amarjit Chopra sir, was the chairman. So that's a great learning experience, and I feel that I've contributed also. But I want to tell you that the kind of work which goes in the deliberation of the auditing and assurance standards. Look at this. If in the CARO, for the CARO as well as for Schedule 3, 4 guidance notes have already come. The CARO guidance note came early because originally we thought it's going to be enacted or made applicable from 1920. But many of us have not seen that or bothered to refer that. Plus, There are three different guidance notes for Schedule 3, accounting standards companies, India's companies, NBFCs. Separately, they have got guidance notes. So please use those guidance. I think I have a slide on that towards the end of this. So so coming back to this, 2013 Act when it came, Section 143, dealing with powers and duties of auditors, and strikingly, and auditing standards. That is the caption of the section. They said 143.9 says, every auditor, not every company, not every director of a company, not management of a company, not company secretary, every auditor shall comply with auditing standards. Why I'm saying this is no more just a dictum of the institute on its membership. It is a very important, demanding, challenging, onerous responsibility on the auditors to comply with auditing standards while doing the audit of companies which are registered under the Companies Act 2030. But still we are very, the compliance levels are dismally poor. Those who are in the managing committee would agree with me that 2 years back, the institute made 2 topics mandatory for branches and regional councils. It should be mandatorily organized, 2 topics. One was standards and auditing, because some of the new council members came in there and found that level of compliance is very poor. The second one was code of ethics, the new code of ethics. That also one has to see carefully. Now, if you take, for example, if you talk about undercutting, undercutting is kind of okay now. We will discuss towards that. Cost-based fees you can got. I can got less than a Big Four, saying that the Big Four has got a huge establishment. We are 2 partners and about 10 people, but from a smaller rented premise, and my cost is only a little less, and therefore I can got less. We're not encouraging that, but then that is also, so Code of Ethics has made a lot of changes. Back to this, the standards and auditing. How many of us have an audit program, which is a mandatory requirement, at least for large audits, SA 300 planning. SA 230 talks about documentation. Are we doing documentation, enough documentation? Is it just a trial balance, or is it with the tax practitioner who has introduced a client to us? That is also a very unhealthy practice that many of our members are very closely associating with tax practitioners, and they do not see the client. They do not know who the client is, what their business is, not visited their premises. It's very dangerous also. KYC also, client KYC is mandatory. Please know that. So with all that, whatever on the issues on the statutory auditors, the management's data should be obtained in the MRL or letter of representation, as we call in our office, all the material concerns. Capability of meeting its liabilities. Now, I did mention the master slide on the 7 clauses, 7 into 3 clauses, that auditor is now expected to look into the future about the prospects of the company, its capability of meeting its liabilities existing on the balance sheet date. And the points of reference they have highlighted here is on the basis of financial ratios. Those who have seen the amended Schedule 3, not many, about 10 plus financial ratios are to be calculated and displayed in the notes on accounts as integral part of the balance sheet or financial statements, financial information. So the auditor's reference, most of the cases in Cochin, Kakinada, Mahendravaram, and West Godavari, whatever we say in theory, in practice, we are the people who are preparing the financial statements. Yes or no, sir?
Yes, sir. Yes, sir.
So we are preparing the financial statements.
Yes,
those strictly we are not supposed to. These are incompatible functions. That is why our students sometimes say, what is the progress of the audit? When you ask them, they say that, sir, statements have been drafted. But we invariably tell them repeatedly that yes, we are helping them, but that is not an audit. The transactions have to be analyzed. Vouching has to be done. Verifications, balance confirmations, reconciliations, related party transactions, assets, the condition of the assets, the title of the assets, ownership and title of the assets. All those things have to be verified. So audit cannot be reduced to a mechanical compilation of financial statements. But then here, with all that, on the basis of financial ratios, aging and expected date of realization of financial assets, including debtors, loans and advances, etc., payment of financial liabilities, loans, trade payables, all those things. All these terms, debtors, creditors are all disappearing. Trade receivables, trade payables are falling. Okay. Auditor's knowledge of the board of directors and management's plans, whether the auditor is of the opinion that no material uncertainty exists on the date of the audit report, that company is capable of meeting its liabilities existing on the balance sheet date as and when they fall due within a period of 1 year from the date of the balance sheet. So to 1 year at least, he cannot be asked to comment on the indefinite future, infinity. So 1 year, whether the company will be able to honor its liabilities and meet its liabilities, external liabilities, all those things one has to take into account. Constructively discuss, get a lot of information, analyze the ratios. Based on that, only the auditor can report. Verify the realizability of receivables and other financial assets. Board's documentation of review of liability position payable within 1 year. Now we have new terms called the current maturities of long-term debt, is it not? Current maturities of long-term debt. In Schedule 3, they have been replaced, replanted from current liabilities to short-term borrowings. According to me, it's a mistake. The new Schedule 3, revised Schedule 3 requires us to put current maturities of long-term debts under short-term borrowings. It should have been ideally under current liabilities. Include specifically that all material events and transactions post balance sheet date, but before the report date that could impact the paying capacity, have been communicated to the auditor. This is something, this is my points taken from the, not my points, the GN points, guidance not points. Sorry. I did mention about CSR 135. Maybe in a place like Kakinada and branches there, may not be many companies who have to mandatorily spend CSR. Though it came in as a friendly section, today they are not leaving it there. The company has to disclose full details in the notes, the notes on accounts, revised Schedule 3. And look at what the auditor has to do. Whether in respect of other than ongoing projects, I'll explain what it is. Other than ongoing projects are, or I will define ongoing projects. Ongoing projects, CSR projects, are multi-year projects. Multi-year projects which will transcend into more than 1 year, 2 years, maximum 3 years, they say. And there, you have to spend that in that given period of 3 years. Failing which 135.5 tells us, the section tells what the company to do. But the first paragraph is on other than ongoing projects, which means that the board decided that, okay, this year we are going to spend so much to meet our CSR liability. But that is being monitored quite well by the ministry. Federal Bank, a company like Federal Bank, with good governance practices, was given a reprimand by the MCA for not spending CSR to the level of the percentage, 2%. There's a shortfall of spending. They've given a reprimand and they have to give it in the board's report. It's a shame. Okay. Federal Bank is a Kerala bank. Now ruling at 88, there are projects, there are, all the broking firms, all the financial advisors are saying that to go up to 120. So maybe a good buy, but no, this is not official. Those who are active in the capital market. Okay. And some of them feel that the market is bottomed out, recent corrections bottomed out, and then now there will be a further, not a very fast, but a gradual rally. LIC's impact has also been, kind of taken or discounted by the market, if it is a right word to use. And then based on that, it could be this thing. This was incidental. So that is, other than ongoing projects, they have to spend during the year. If they fail to spend on 31st March, within 6 months from the expiry of the financial year, they have to give it to any of the specified funds in Schedule 3. It will go to the government, Prime Minister's Relief Fund, Dot Relief Fund, Flood Relief Fund. It will go out of the company's coffers. That's the first clause. That is other than ongoing. In the case of ongoing projects, the company is required to transfer that to a special account within 30 days. This 30 days is a requirement of 135.6. There we have 6 months. Within 30 days, this has to be transferred to an account. And this can be utilized only for the said ongoing CSR projects. It's like our capital gains account. So this is clause number 6, new clause number 6. And new clause 7 is whether there have been any qualifications or adverse remarks by the respective auditors and CARO reports of companies included in the consolidated financial statements indicate the details of companies and the paragraph numbers of the CARO report containing qualifications of adverse reports. This is applicable only if you are a holding company auditor. Then you have the which have been included in the consolidated financial statements. Ideally, consolidation, when we say now we do not consolidate subsidiaries and joint ventures, apparently the implication is that this, in the case of subsidiaries, we have to call for the auditor's report. Anyway, it has to be ready because consolidation has to be done. And adverse remarks, if any, indicate the full details of the companies and paragraph numbers. That brings us to the end of the 7 new clauses. I hope we have discussed fairly in detail. Moving on to the modified clauses. Fixed assets, we had this point. Whether the company is maintaining proper records showing full particulars, including quantitative details of and situation of property, plant, and equipment. Now, fixed assets, tangible assets, all these terms are completely gone. We talk about property, plant, and equipment and intangible assets in the case of intangible. Now, look at the new reporting requirement, whether the company is maintaining proper records showing full particulars of intangible assets. The tangible assets itself, I still have the term fixed assets there. I don't know whether that is in CARO, I'll double check. That's a copy issue. So in the case of tangible assets itself, most of us were washing our hands saying that there are companies maintain records of fixed assets, which however requires to be updated. I don't know whether the same thing can apply to intangible assets also. Now the startup companies, IT companies, there are a lot of intangibles. Earlier days, seniors would agree that the moment we talk about intangibles, it's only goodwill. Now it is mostly computer software, web design costs, all those things which are the IPR rather, intellectual property rights. Therefore, that can happen. So this is the new clause. One has to align with the thinking. And fixed assets register, quite unlike what used to be in the olden days, or maybe 20 years back. Today, a spreadsheet, Excel with 30 worksheets, can be the fixed assets register, properly authenticated, or comes with a covering note as an email from the Director of Finance. It's fair enough. We don't have to have hard copies. We used to have this big registers. I did my articles in Chennai. I remember checking all those with depreciation of every year. It was meticulously written in some of the companies. But majority of them do not give much of an importance. Therefore, the new clause is on intangibles. Whether property, plant, and equipment have been physically verified by the management at reasonable intervals, this is already there. Whether any material discrepancies were noticed on such verification, if so, whether they have been dealt with in the books of accounts. Now, the next clause is new. It's not new, it is there. It is now there in Schedule 3 also. Whether title deeds of all the immobile properties other than leasehold property in the financial statements are held in the name of the company. If not, provide the details thereof in the format given. I don't think the format is there. Format is, we have to give details of property, plant, equipment, investment property, other inventory like that if you're holding, immobile property, if you are holding, then you have to see in whose name it is held. That is a tabulation I'm explaining. In whose name it is held, 1. 2 is the reason for not holding in the name of the company. Okay. So that is how it is. But this is a very, according to me, all the immobile properties which are finding a place in the financial statement should be in the name of the company. But in a discussion last, about 5 days back, we had a residential program of the Coimbatore branch in Munnar. So there they said that there's a conversion, partnership conversion, all that happens in olden days. In such cases, it would not have become in the name of the company, but the company is the beneficial owner and legal title also cannot be disputed because it came through a conversion process. I was almost agreeing there. But there we have seen cases in an investigation we did for official liquidator of Kerala, High Court of Kerala, 18 high-value properties of a company which had floated something like Ponzi schemes and cheated the public. The promoter then finally was caught, he was arrested, then he attempted suicide. It was quite a mess. And many people lost their money. And there, the 18 of the high-value properties were just newly bought after the company was incorporated. No conversion, nothing. Were in the name of the managing director, his wife, and his son. So the auditor had happily signed the balance sheet. So CARO 2016 introduced this clause. It now comes with more substantial details of whose name it is held and why it is not held in the name of the company, etc. And classification between PPE, investment property, inventories, others. If there have been revaluations during the year, if it is done by a registered valuer, and if change is 10% or more in the aggregate of the net carrying value of each class of equipment, whether then the details will have to be given of the revaluation, and if the change is more than 10%. Otherwise, it's not required to be disclosed. The other point is again relating to fixed assets. I think CARO still uses that heading. Whether any proceedings have been initiated by the company under the Benami Transactions Prohibition Act, pending against the company already initiated during the year pending. This is a new reporting clause. And if so, whether the company has appropriately disclosed the details in its financial statements. I'm not an expert on that particular law. What can happen that companies may be just holding property for the sake of someone, or to get over the land ceiling issues. In Kerala, we have a land ceiling of 15 acres for corporates and individuals. So where this may be held just as Benami, and action would be taken. And it could be colored money in some cases, where, a lot of unhealthy transactions, money laundering would have happened. If that is there, the full details. The auditor will continue to ask. Auditor may enlarge companies. The auditor may discuss with the legal counsel, the advocates, and also the guidance note says you should also scrutinize the legal and professional charges paid by the company. If there is some litigation they are hiding from us, probably by looking at the bills of these advocates, we would know that, okay, for representing the company under the Benami Transaction Property Act, if you get it, then yes, you have a point. And then you have to dig further until the management gives you the full details, completely divulges all the information. So this is a reporting requirement as far as fixed assets or other property, plant and equipment are concerned on Benami transactions. Inventory, we did see there are changes, but I put in a different color. Whether physical verification of inventory has been conducted at reasonable intervals. Whether in the opinion of the auditor, the coverage and procedure of such verification by the management. Please excuse me for a minute. I'm sorry.
Actually, it's stuck up at inventory too, sir.
No, I'm coming back. I just took a.
Okay, sir. Okay.
I want to mute for a minute. Just give me 1 minute to come back.
Sure, sir. Sure. Okay.
Are you able to see the screen?
Yeah. Yes, sir.
Yeah.
Yes, sir.
So coverage and procedure of verification by the management is appropriate, and whether any discrepancies of 10% or more in the aggregate of each class of inventory were noticed. If so, more than 10% if it's notified, then it has been dealt with in the books of accounts. Now this, again with the banker's angle, there are a few points which are common. Majority of the points that way, if you see, coverage and procedure for physical verification. Now the very simple question is, how many of us or rather our representatives attend physical verification? During my articles of 3 years with the firm called Verma and Verma, they have an office in Hyderabad. Andhra, they do not have, I think. Predominantly Kerala-based firm, but they are in Pune, Mumbai, Madras, Chennai, Bangalore, everywhere. And we used to go for physical verification. on 31st March or a date near there too, depending on the availability of staff at the auditor's office as well as the client's office, client's convenience. In my office also, in our practice also, we do for all the companies where we have substantial value of inventory. This is actually mandatory. If you look at SF 501, SF 500, all the 5 standards starting with 5 are relating to evidence. SF 500 is on evidence. SF 501, the exact wording, it is additional considerations for specific items, selected items. One of the selected items which the standard is asking the auditor to do is physical presence during inventory verification. Or are we just saying that management gives a trading stock, manufactured stock of 2 crores, trading stock of 1 crore and 3 crores, it is signed by the finance manager, we are saying that is fine. It shouldn't be the case. It shouldn't be. There should be stock records. Today, some of them work under ERP, SAP and all that, ERP systems. Even Tally inventory, some of them have customized really well. Very few of them. Majority of them are still stock in Tally. Stock in Tally is a mess. But we need to have some comfort there that the management has done the verification and physically done this. During COVID, I'll just share with you, one of my friends in Rotary, who is also some consulting service we give to him, a very senior person. His company was taken over by Indigo Paints. Indigo went for an IPO, right? Indigo went for IPO and it has become a multi-bagger now. And his company, HP Building Products, was taken over by Indigo as their national horizontal acquisition plan. Across the country, they took over. And this person is an IIT IIM. And he has good quality and systems with a reasonably good volume, market systems, governance practices. And after the takeover, the audit has been shifted to EY. EY Pune office is coordinating. So this gentleman asked me, Jomon, can your team do a physical verification, if partly for the management and partly for EY? Then we studied the scope of it, spoke to EY, they gave 3 names at various levels, we spoke to them. And finally we said yes. So the instruction was like this, a partner has to be there, minimum 2 assistants, we send 3 assistants. So the first thing they have to do is that to go in front of the factory and with the managing director, of course, he was there. With somebody from the management, you have to take a groupie photograph and WhatsApp it to the EY team, proving that you have reached there. Then the entire stock verification process was video streamed. And at 3 o'clock in the afternoon, they said, already we have picked up samples of about 20 each from finished goods, raw materials, etc., etc. And they suddenly at 3 o'clock, they asked us to verify random, another 5 items. I think it was raw material finished products. My partner was engagement partner, my partner was engagement partner. So this is the action. And then finally, with that, there is a Zoom meeting after that. Documentation is done. And the reports we have to give are very heavy, very detailed reports we have to give. We charge them also. It was only a day's work, but we knew that the reporting will go for another day. And we charge very well, though he's a very good friend of mine. It's a cash-rich company. Why give credit? Why charge less? These are things also we should discuss towards the end of the session, if time and mood permits. Now, so we said after signing up, this is a fees, and being a one-time assignment, there will not be any credit. We will not say it will not be any credit. We said, and shall be payable immediately. And he honored it. A fine gentleman he is, and he honored it the very next day. So that's how we should do. And I was just trying to give examples of how larger firms in the time of COVID, since they were finding it difficult to send a team. So this kind of things we can also practice. Everyone has a WhatsApp, everyone has a smartphone. So verification, test verification of high value items. Now drones are doing it. There are a lot of ways of doing it. So this is a mandatory requirement, a modified clause 2, whether the coverage and procedure for verification of the management is appropriate. This is purely from a banking point of view. So just give me a minute. So if there have been borrowings or sanctioned working capital limits have been sanctioned in excess of 5 crores from banks and financial institutions on the basis of security of current assets. Ideally, we take ODCC and all that. Whether quarterly returns and statements filed by the company with such banks or financial institutions are in agreement with the books of accounts of the company, and if not, give details. Now, wherever we discuss, members raise this concern. Sir, the client will not have copy of the quarterly report. So that you have to get it. Mandatory, it's a requirement. And here again, look at the starting point. I wanted to make a constructive interpretation of the saying that this clause would be applicable only if the company has been sanctioned working capital limits of X of 5 crores at any point of during the year. But many of the seniors advise that could be too constructive because annual renewal is also to be considered as a sanction, and therefore either sanction or renewal of working capital limits in X of 5 crores, this clause would be triggered. This reporting requirement would be triggered. Quarterly returns and statements filed with the company. Okay, we managed to get it. Company has a good practice of keeping either a hard copy or a soft copy. You get hold of that. And what are we supposed to do? Whether they are in agreement with the books of accounts of the company, if not, give details. Receivables, stock and receivables. Receivable to some extent, if you take the quarter end trial balances or financial statements which you can generate with aging and all that from the system itself. Even Tally can generate that. There's something to compare. But people ask then, the next question is, sir, where is the stock register, sir? We have not seen a stock register so far. That is precisely why, at least in the case of larger companies, they want to discipline the corporates as far as inventory, fixed assets, receivables are concerned, age management, collections and payments management. So this is a particular point which we have to report. Raj Talluri sir asked a question in the chat box. Yeah, I'm okay. You can post questions in the chat box. Sir, is it really possible to verify stocks physically in big companies? Yes, sir, we should do it. We should do it. May not be 100%, but if there are 3 different locations, at least 2 locations, you should verify where the large value inventories. The management team has to come into play. Primarily, it's a requirement of the management. And the auditor would only oversee. We instruct our students that do not go physically, carry the sacks and all that. You do not do it. Get a team there. You go there with the writing pad and make sure that's or laptop or iPad tab and then get it done. This has to be done. So why big companies, they have the infrastructure. I think the problem is the small companies. If you talk about the volume is huge. Whether they physically exist, whether some of them have perished, a lot of things can happen. I remember going for a stock verification when we were doing the audit of Canara Bank, Avenue Road branch in Bangalore. My senior and myself, I was a first year article. And we picked up a company called Goguldas Fashions, which was into deep trouble. We wanted to visit their godown, where export quality garments were kept, stored. We went there. It was very difficult to open. The godown is not open for at least 2 years. That screechy sound is coming in. Then all these rats, cockroaches, everywhere coming out. And we got in, and finally, manager, Mr. Kinney, and deputy manager Kamath, I distinctly remember. It was for the 87 December audit. That was my first year. And then we started looking at the quality of the products. The nails, they were used, now we use the plastic clips for shirts and all that. They were rusted and it was all kind of completely gone. And then that was called stock, and there was no verification from the management, or rather from the bank. And management was least bothered. Then immediately after that, on driving back, the manager asked his deputy, Mr. Kamath, if it is sufficiently insured, we will do one small this thing and finish off. Yeah, shortless action. He meant he will put it on fire, set it on fire and claim the insurance. Just maybe younger members are also there. I call it audit inquisitiveness. Auditors further acumen to inquire further. We were in the backseat of his Fiat car. My senior uttered in my ears, Joe, he calls me Joe. Joe is now a financial consultant in Botswana. Joe, just go and see whether the insurance is renewed. First thing. So post lunch, we went and checked the insurance register, which was handily available, and found that it was not renewed for 2 years. So Gobi went and said slightly sarcastically to the manager, Mr. Kinney, before you do this thing, Please renew the insurance, otherwise you'll have a huge problem. So that is how the level of inventory by the constituents and by the companies, even where there are no loans. Tell me, the internal control service, which companies, most of the companies' internal controls are not there at all. In our office, in our practice, rather in our firm, we have developed a new vertical. We call it corporate doctor. The corporate doctor is not an audit. We cannot do this to audit clients. So medium and large clients, we give a proposal that we would do a scanning, a blood test, a urine test, whatnots, an ECG, EE, treadmill, all that, and analyze whether the controls, reporting protocols, MIS are in place. And then we also say that, oh, these are the issues. This is a diagnosis. And then we also give them prescriptions. You need a finance manager. You need a good software. Nothing is there. You need a good finance person. Your old MCOM guy, MCOM failed guy sitting there as accountant. Not because you've grown big. You need to have a better hardware of a network of systems. You need. A lot of unproductive copying work happens. In a hospital where we did this, I'm not saying from the point, I think it's relevant and a new area for young members to specialize and focus on. Because many of our customer areas have disappeared. GST audit, tax audit limits getting increased, etc. Then we found that there's a hospital management system of Wipro, about 2 crores a pay. And then the end of day reports were printed out and then manually entered into the tally. I said, hey, what's happening? There should be an interface, there should be a bridge. So that is as an engineer from Wipro. Yes, sir, what you said is right. In fact, Wipro has a product called Bridge, which is primarily to interface our operating system with the back-end financial software. So, and then we continued there for some time, delivered value, charge a good fee, and then we held their hand for about 3 months, and then they could take off. I don't know what's the state of the company. Sir, how can we trust the genuineness of the copies of statements furnished? Furnished by the client, shall we approach the banker? The banker may also not apply, saying that, stating that the amounts to disclose a confidential information. Sir, here you have to get it, and you have to get it from the banker through the client, a certified copy. Most of the cases it will be there. I don't think I have had a problem there. The companies keep a copy, but your question is whether those copies are genuine, authentic. That one step extra is always better. After the Satyam episode, in fact, many of the Big Four had started collecting bank confirmation, balance confirmation statements from the bank directly. So there's absolutely no prohibition. Where in a regular case, in an ongoing client, reasonably good client governance practices, good directors, etc., you may not have to go in that detail. Some amount of trust can be placed if it's authenticated by director of finance. But where the systems are wayward, where they have financial problems, where there is an environment, there's a need or a pressing situation to misrepresent to the bankers, one has to be extremely careful. So you would do well if you get a copy from the bank through the customer. BB Satyanarayana sir, you are there. You asked a question. Sir, please unmute and speak. Sir.
Thank you. Thank you, sir.
Yes, sir. Okay, good. The company was registered as a public company and purchased lands in the name of the public company. Later on, the company was converted to a private limited company. Is it necessary to report about the name change in the CARO fixed assets clause? No, leave alone CARO for the time being. When the conversion happens, I think you have to notify that in the village. And there will not be any mutation because conveyancing is not required. It is a change of name only. It's a change in the constitution only. So in the village records, I don't know what the practice there in Andhra is. Ideally, it should be got changed with the documents, the conversion documents, the certificate of conversion from public limited to private limited. Village hospital is convinced, yes, that will be converted in the name of private limited company. The name will be changed in the village records. We call it Tanda Pere in Malayalam. So that happens. It's not required to be reported in CARO because it is again a conversion and ownership, beneficial as well as legal ownership is with the company. So there is no question of that not being held in the name of the company. That issue does not arise. Shall we move on? Yeah, okay. So this quarterly returns is challenging. We have to get it from them. And also the stock records. Somebody is talking about big companies. I think it was, yeah. So in the case of big companies, let me ask you a question, a very friendly question. Have you sent a communication to our clients, to a client saying that there are revolutionary changes in Schedule 3 as well as reporting requirements in CARO? Therefore, you have to keep the following details ready. Where there is a corporate accountant, there's a chartered accountant, there are 5 to 10 people in the accounts department. I'm sure majority, maybe none of you would have done that. I insisted, told my partners that we cannot do all this work. Let the company accountant also do. And we sent a mail about a week back saying that we have to keep following details ready. Age-wise analysis of debtors in that 5-column format, trade payables, aging of all these things, then the copies of, where in the case of more than 5 crores, clients will set copies of financial, the documents, quarterly returns filed with the bank. And what we have said is, we have asked it to put it slightly a tricky fashion. And the basis on which the figures in the quarterly returns were determined or arrived at. That way we have asked. And whether has there been any proceeding, income tax, etc., something like a checklist we have sent. And then we'll get it from them. We even earlier had a practice of sending what we call it as checklist for audit readiness. On top of that, we have added a new thing, checklist kind of a thing, a mail is gone. Please do have, my request is, as chartered accountants, we are taking all the trouble of the clients. The client is not bothered. If he's well off, when we are burning the midnight oil, finishing a tax audit, this thing, or even a SFT return, now there are a lot of issues. The client would be happy sitting in a club or a bar, having a good time. And the corporate accountant would most of the time leave at 6 o'clock. We and our students really struggle, and then without any result. Commensurate fees is not there. We are scared to ask fees. And also, I'm seeing that many of the chartered accountants who do not have bad habits like smoking, drinking, overweight, all those things, many of them are having health problems. In Kerala, when I analyzed a few of my friends, it's purely because of work stress, office work stress. They don't eat on time. They don't get proper sleep. If there is an income tax assessment tomorrow, they will not sleep. And the client would happily sleep, snoring. I'm not saying that we should disrespect the client, but what is required is a detached attachment with the client, and the commitment in terms of professionalism should be more. Clerical aspects should be reduced. And today there is going to be, there's news, I don't know whether you heard that articleship is going to be reduced to 2 years now. Already we have a shortage of students. And they have in the last, tomorrow, many of the students are going on leave for their fine, because they have to do the MCS and the ITT, as said, AICITS, Advanced Integrated Course on Information Technology and Soft Skills. Plus, we give 3.5 months study leave for the first attempt of file. So 5 months for the third year, the student is not in office. So with all that, we take up all the headache of the client, all the routine work of the client. If there's income tax assessment, we go take details, flag it, flag it, all those things. I think we should change that culture a little bit. That is incidental to saying the difficulties the auditor would have in complying with the CARO-2020 requirements, as also Schedule 3, because at the end of the day, we are going to do it. To those who came late, I had taken an apology for sipping a hot tea because I'm having a sore throat. I was in Munnar, I told you, so it was very misty there. And so climate in Kerala is raining, it's very cold now here. I live in Kochi. Moving on, sirs. Repayment of loans granted by the company. Whether the company has provided loans, advances in the nature of loans, stood guarantee or provided security to any other entity. 2 categories, A and B, big A and capital A and B. Capital A is for subsidiaries, joint ventures, and associates. B is other companies, other entities. What is that? The auditor has to give aggregate amount during the year, balance outstanding at the balance sheet date with respect to loans, advances, guarantees, etc. This clause is not applicable to companies whose principal business is to give loans. NBFCs is not applicable. But non-NBFC, we used to have a term called non-trade investments now. So it's not related to the business of the company. And therefore, if they have given loans to subsidiaries, etc., should guarantee full details. Other than subsidiaries, joint ventures, etc., associates, that also has to be given separately. and whether the terms and conditions are prejudicial to the interests of the company. The loans which have been given, interest-free, companies borrowing from an NBFC at 18%. Yesterday, we were asked to certify the arm's length basis of a transaction between two major NBFCs. The interest rate proposed was 15%. So we were seeing it from the borrowing company's perspective. We are on the borrowing company side. Lending company is also a group company. So whether this 15% is at arm's length, as per acceptable practices in the NBFC lending, buying, money market operations, etc., and we gave a report. We gave an opinion. And here again, I would also say that many of the clients, finance managers over the phone, even the accountants say that, sir, we need a certificate over the phone. Do insist on a letter or minimum an email. Quote that email in your certificate and do bill it. So whether this is prejudicial to the interest of the company, borrowing at 16%, and then giving to an associate, where company is holding only 30%, 70% is held by director's wife, then giving it free. So 16% on the one side, you have a cost. You have no income, revenue, matching revenue from the loan which is given to this associate in the example side. In respect of loans and the advance in nature of loans, whether repayment of principal and interest has been stipulated and they are irregular. And look at clause D, they have brought the IRAC norms here also, indirectly, income recognition norms. Whether the total amount overdue for more than 90 days and whether reasonable steps have been taken by them. These many details are to be given if the company has granted loans either to its subsidiaries, subsidiaries, associates, joint ventures, to any other entity. That has to be given. And this is about the fallen due during the year and renewed, extended, etc. All these are subclauses that they talk about, and also asking us to give the percentage of the aggregate of such loans and advances to the total loans and advances. Here again, not applicable to companies whose NBFCs are principal business. Same here, the second clause also. Here we can go fast. Now, past due reporting, I have just highlighted some points. But look at this last point, whether reasonable steps have been taken by the company. How will the auditor see? So consider the facts and circumstances, the amount involved, and the steps have been taken must necessarily be legal steps, need not be. Communication with the management in writing initially to start with. And there's some reply to that, saying that we would say something failing which will be forced to go for initiate legal action. So at least some kind of efforts have been taken. Or is that more than 90 days are going, it is given and let go? It should not. The management should be judicious in trying to collect all this. I think we have a question there. The quantities in stock statements given to the bank were tallied with the quantities in accounts. However, valuation was different in bank statements and accounts. Yeah, this valuation quantity as well as value have to match, sir. So this will, if the valuations are not matching, bank you are given an inflated figure and you're showing actual figure. And we are also reminded of AS2, valuation of inventories. The standard is very clear how to value raw materials. The cardinal principle is cost or market, net realizable value, whichever is less. Inventories are to be valued at cost or NRV, whichever is less. If there's a substantial amount of work in progress, we will show it at cost because work in progress may not have a net realizable value in that half finished condition or half done condition. Okay. So I hope I answered the question. If it's not just a quantity, the value, everything has to be pie to pie, as I say, should be tallied with the bank side. So this is about past due reporting I was trying to highlight. Modified clause 4, this is a default and repayment of dues. The previous clause 3 was on loans granted by the company to related parties, etc., etc. Recovery, prejudicial to the interest of the company, reasonable steps have been taken. Interest terms and conditions have been prescribed. If not, also that has to be highlighted. Now here it is whether the company is defaulted in repayment of loans or borrowings in the payment thereof to any lender. If he has a period and amount of default should be given in the format below. There's a table here. Whether then the next question is a new clause. Whether the company is a willful defaulter by the bank or financial institution or other lender. Now, how do we get this as a willful defaulter or not? We have to communicate with the bank and the financial institution. But if I'll tell you, we don't have to approach every situation with suspicion. though all of us now beg to differ, that to the Kingston Cotton Mills case statement, or rather the judgment, where the learned judge said the auditor is only a watchdog and not a bloodhound. The auditor has to be via media now. He cannot just remain a barking watchdog. He has to go further. If he smells a rat, if he suspects something, suspects fraud, irregularities, he should do deep dives, deeper drills, and find out either he's able to confirm or dispel this doubt. It's very important. So declared willful defaulter, they have drawn a reference from RBI's master circular. In the guidance note, they have mentioned that. He simply said it's one who has got the resources, wherewithal, etc., etc. But adamantly, he's saying that he will not pay. It's not a company which has gone down. A poor NRI coming back and starting a restaurant, spending about 2 crores, and due to COVID, the whole thing is closed down. He may be defaulter, but cannot call him a willful defaulter. He must still be willing to tell the bank that, okay, release the collateral and take the money to the extent you can. But in other case also, willful defaulter will also include one constituent who has completely diverted the money for a different purpose. They gave a project report, which all of us help our clients prepare. Another area which I'm specializing in. So project report we give and saying that this is for constructing about expansion proposal of the chili powder factory or crushed chili factory in Gunduru, Bhairava. Then land has to be purchased. Project report says that land is already there. Company has got 2 acres of land adjacent to the existing property. 20,000 square feet of building or Kirby construction has to be done. Yes, there is a project report called. Machineries have to be brought in. Electrification has to be done. Trial run costs, etc., etc. Some vehicles, office equipments, lab equipments, if a quality has to be there. With all this, finally, this money is taken, drawn from the bank. It is completely diverted to the loss-making subsidiary, for example, or for the working capital crunch which happened to the losses of the existing factory itself. It can happen. All those will make him a willful defaulter. Whether term loans were applied for the purposes for which they were obtained, if not, give the full details. Sir, look at the point clause D, which is a very important point from the financial management point of view. Prudent financial management, very clear that short-term funds should never be applied for long-term applications. The vice versa earlier, when 2003 CARO came, the vice versa was also there. Then they found that the vice versa is redundant. Redundant because long-term funds to some extent has to be applied for short-term applications. That overlap is allowed, that overlap happens. That's actually healthy. But even a single pie of short-term funds getting into long-term applications, you would get into a vicious circle from which you have no escape. We have seen so many live examples. In the past 30 years of my practice, many of the corporates where we strongly advise them, go for a loan or bring in some equity promoters, etc., etc. I said, no, working capital will get an enhancement and use it for asset acquisition or repayment of a long-term loan, etc. They have all been in trouble. So the company has taken any funds from an entity or person on account to meet the obligations of subsidiaries, associates, and joint ventures. This company, our auditing company, is just acting as a conduit, a connecting link for taking money from someone and then giving it to your subsidiaries, associates. Because those companies may not be doing well. They may not have the credibility or the eligibility or the rating to borrow from the market. So this company, which is reasonably okay, is trying to get a loan and then they're passing it on. So it's a loan taken, loan given, the same. If that is there, that has to be higher. Not desirable at all. Pledge of securities held in subsidiaries, joint ventures, etc. Also, we have taken loans, that also should be separately highlighted and given. Reporting of frauds. Fraud reporting is under 143.12. But there it says that if the amount involved in the fraud is more than 1 crore, the auditor should send the details to the central government. He cannot confine just to the board of directors or management. Send to the board of directors, send to the central government. The form is ADT 4. All of us know what ADT 3 is. This is the very next to 4. ADT 3 is a form which we file for audit resignations or not. Whether that has been filed with the central government. And also related to that, whether the auditor has considered whistleblower complaints, if any, received during the year by the company. Whistleblower complaints, it could be a major irregularity, a major dip in the market share, employee frauds, exodus of people, non-availability of raw materials where even going concern would be at stake. So whistleblower are matters which are of huge intensity, which can impact the substance and existence of the company, where one has to, the auditor has to consider. Again, all this substantial amount of this in discussions and letter of representation. Our LOR has been modified. Today also I asked morning, I asked an assistant that all these points should be captured. It should be an exhaustive LOR. LOR is MRL, Management Representation Letter, otherwise called. Mandatory requirement under SA 58. And SAs are mandatory under the Companies Act 143(9). With this we can go on. Nidhi companies are having a trouble now. In Kerala, at least I know that this NDH4 or form has been filed and ROC is not renewing their licenses. Ideally, they are meant for like cooperatives. More than 200 members, they can transact, take money from the members and give it to members. And there's a spread, you can work on that. But many malpractices were there. This route was being misused. So there is a restriction. But leave alone that. The auditors, if the company is a Nidhi company, if it's not a Nidhi company, then we'll say that clause 12 of CARO 2020 is not applicable. Many clauses could be there. So that will be the last point in your CARO report. We have reported all the applicable points and they say that clause 5, 8, 9, 12 and 14 are not applicable to the company. The small Roman small letters. Whether Nidhi company has complied with the net owned funds to deposits, the ratio is 1:20. 20 times the net owned funds, they can accept it. Fairly large amount of leveraging made possible. If that is exceeded, the audit has to report. 10% unencumbered term deposits as recorded in Nidhi to meet out the repayment liabilities. The companies take deposits. So at times something happens, Kerala also, there's some bad news. We call it a run in the bank. So they would demand repayment of the deposit. Then whether there is sufficient 10% unencumbered term deposit question. There's been default in the payment of interest or deposits, repayment thereof. That is also that is a depositor's point of view. This is a good, healthy point. That's a new point actually. Other two are already there. Been modified. I hope it's clear. So whether any interest or principal repayment have been defaulted, the full details will have to be given. Clause 7 is the one which we used to report. Whether the company is required to be registered under 45 IA of the Reserve Bank of India. If so, whether that has been taken. So how do we know whether this company, it's not registered as an NBFC, it's a trading company, but then trading has not there much. So let's say that they get into lending if they have sufficient resources, or take some loans and start lending. So one of the tests which they have asked us to do is, I've jumped to 2 slides and look at the last bullet point. Examine the financial statements to ascertain whether the company's financial assets constitute more than 50% of the total assets, and income from financial assets constitute more than 50% of the gross income. If that is the case, there's a reasonable inference, or there is kind of recent thing. This is RBI directive. RBI says that in that case, the company has got into the NBFC business, which requires registration with the Reserve Bank of India under 45. I hope that's clear. And the second question is an offshoot of that, whether the company has conducted any NBFC business without the valid certificate of registration from the RBI. Whether the company is a core investment company as defined in this, if so, whether continues to fulfill the criteria of a CIC, and in case the company is exempted or registered CIC, that continues to fulfill such criteria. The core investment company would act as primarily an umbrella under which there will be a lot of subsidiary companies. And they do not get into any business. They are primarily core investment company. So fall into that definition, then yes, we have to see whether the conditions have been satisfied and indicate the number of CICs which are part of the group. More than one CIC if it is there. Because we look at 287, I don't think they brought it in CARO, but in Schedule 3, there is a new requirement to report whether the company has complied with the number of layers as required or as mentioned in 287. 287 is where they say that in a chain of holding and subsidiary, a company cannot have more than 2 layers of subsidiaries. A company subsidiary is B, B company subsidiary C, C and D cannot be there. But if B is 100% subsidiary, that's an exception. Slightly different. In relation to this, I was trying to say, that's why CIC could be a tricky situation where, the investment planning would be done in a different way. RBI directives we have seen. With that, we have come to the end of the points under CARO. But alongside CARO, they have made some amendments which some of us have not taken note of. This has to be given in the auditor's report. There's a paragraph, other legal and regulatory matters. Okay. This is again in relation to money laundering. Money laundering. I was giving this example. Where was I giving this example? I think in Coimbatore Residential. I am a company sitting in Kochi or Rajamahendravaram or Kakinada. I'm getting a fund from one company, XYZ company in UAE, or a tax haven. Tax haven benefits are slowly disappearing. But I'm getting an amount from a UAE with an instruction that 10 crores will be transferred to you, with the instruction that you have to transfer this to a company in, let's say, Sri Lanka. A very undesirable to transfer funds to Sri Lanka now, it may not come back. Sri Lanka economy is in completely bad shape. So this is where they say that this is a money laundering transaction. That company has a direct nexus or some kind of relationship, unholy relationship between UAE and Sri Lanka. And you are using a company in India as a connecting link, as I mentioned, a conduit for transferring funds. In such case, we have to report. So this company, our client company in India, technically in that is called an intermediary, and the Sri Lankan company is called the initiator of the transaction. And here the management, see again there the question is auditor's report. What? Whether the management has represented that no funds of such or and whether the believe that representations were misstated. Same way it is received, similarly it is given also. That way also is applicable. So one more amendment has come in this rules. Companies, auditors, audit and auditors rules 2040. The chapter on audit under the Companies Act, I reiterate, is chapter 10. Audit and auditors, section 139 to 148. The allied rules. All of us know that Companies Act is a delegated legislation. We have many of the things under the Act, where some sections say that as may be prescribed. And we find the prescriptions under the rules, in the rules. So this is A&A rules, audit and auditors rules 2040. All the rules took some time. 13 is the Act, or year of the Act. 14 is where they got ready with the rules. Whether the dividend declared or paid during the year is in accordance with section 123 of the Act. So these are the points which I thought would be relevant for CARO, and these two slides are a red slide. And we will continue to interact. This is my email ID. This is the website of our firm. We can, website also, there's some useful information. Some formats may be there. And it's absolutely free, it's not charged. We have a chat. A company which is having net worth of 8 crores has invested its money in the shares of listed companies as investments. It's listed to register of the company with the RBI at 45 of the investment as investment company. A company having net worth 8 crores has invested money in. The entire net worth has been invested in shares of listed companies. Satyanarayana sir, what is the main business of the company? Main objects of the company? So if the main objects were initially investing in shares of listed and unlisted entities or whatever, ideally at that point of time itself, it should have been registered as an NBSE, as an investment company. This is very clear because I have given the indicators. 50% of financial assets, 50% of revenue comes from financial assets. Then yes, naturally, they will have either dividend income or the profit or loss on trading in these listed company shares. It has to be registered. It goes without saying. So this is a mail ID, and this is so. With that, we'll take a few questions. If there are questions, I'm only happy to answer. And we have completed in 1 hour 45 minutes, even less. We had some initial takeoff troubles, but I hope I have not gone in a hurry. We can recap some of the provisions if it is required. So with that, let me say once again, a big thank you to the 3 branches for inviting me, once again inviting me to these 3 branches, Kakinada, Rajamahendravaram, and West Godavari, branches which are very close to my heart. I've interacted with many of the MC members. I also recall your support for the conference as well as for the orientation program we had during my chairmanship in the city of Kochi. So all pleasant memories. Let us continue to learn together. Let us get, be abreast of the latest developments. And at that point of time, I would also say that if there are multiple partners, firms with 4 or 5 partners, please stop doing everything, every partner doing everything. Specialization has to evolve. We are 5 partners in our Cochin office, 2 in Trivandrum, and we have an associate office in Dubai. My audit partner, I can go to that extent of saying that the partner in audit and taxation partner does not know how to incorporate a company. Similarly, the partner compliance he's not doing major audits. So it is not for the big 4. We can also apply that, and over a period of 2-3 years, specialization will emerge. And we have an exclusive GST partner. It's also, a young partner who is in charge of GST, but we still doubt our capabilities on higher end advisory. Basic compliances, registrations, opinions are all there. But a foreign company with multiple transactions giving an opinion, so we'll get up to the next level of consulting and deliverable capabilities. When a negative comment was made in CARO, is it necessary to report the same in the main report, either as qualification or otherwise? So it's a good question, because if that is big enough or substantial enough to invite a qualification in the main body of the report, you have to. But doesn't mean that every negative comment in CARO has to be brought into you have to apply your judgment. And every negative report in CARO will not result in an adverse remark or qualification or even emphasis of matter in the main body of the report. So with that, sir, it is back to the team. I will stop sharing with your permission.
Thank you, sir. Thank you very much, sir.
Yeah,
actually, we thought of joining 6
Pancha CA Panchakshari wants to speak.
Panchakshari.
Sir, this one, in one private limited company, the HPCL and the APGDC are the shareholders. Since the joint agreement, they are the shareholders. But this one company, HPCL, has made the share application money, and the state government company has not made the share application money. This one allotment. Rights issue. Rights issue, they have unable to bring that amount. This one, so whatever the this amount received, they have shown it as other results. If we are allotting the shares, that state government share will be decreased.
Yeah.
Whether it is correct?
No, it's not correct. Because what has come in as share application money should be shown as share application money only. Governmental restrictions or governmental issues may come, but then based on the original plan, this money has been brought in by HPCL, you said, no? As share application money. Ideally, this should have been allotted in whatever proportion within 60 days. Within 60 days, it should have been allotted. And if not allotted, within 15 days. So put together 75 days, this should have been refunded. If it is not refunded, it has to be shown as another current liability.
This is the rights issue, na? There is no such obligation, na?
Which one, sir?
In rights issue, there is no such clear cut how many days it should be allotted like that. Na?
No, but I'm talking about the refund if it's not allotted. Rights issue is the right of preemption. Existing shareholders are offered shares.
Oh, yes, sir.
They can decide not to invest and then can go to somebody else. But compliance is, as far as compliance is concerned, both rights issue and private placement is on the footing. Otherwise, it has to be refunded. So what the company is doing, saying that the other party, you said RP something.
APGDC, State Government
Andhra Pradesh Development Corporation. Okay.
AP Gas Distribution Authority.
Oh, Gas Distribution Authority. Okay, they are not able to bring in the funds. Then disclosures have to be proper. You have to give ask management to give a very detailed note. And you have to, if there is, but this may not invite an emphasis on matter, because from a financial true and fair point of view, there is no difficulty. I mean, it is not getting vitiated. True and fair is not getting vitiated. It is more of a process-based delay, which is with this funds getting parked temporarily. Am I right?
Yes, sir. Yes, sir.
Yeah. So you have to give a detailed note, ask the management to give a complete detailed note that it is because of this, the allotment is pending, the amount is shown under other liabilities.
Okay, thank you.
Nice. Yes, back to you. Thank you
Sir,
so much once again. To all the participants also, we have
thank you,
as
sir.
of now.
Thank you very much, sir. Actually, we thought of planning of, joining 6 branches, sir. Tirupati, Ongolu, Nelluru, Kakinada, as well as Rajamahendravaram and
That will become a regional
Godavari.
conference.
But due to the, some other lack of this one, so we could not manage the 6 branches. Next time, definitely we will have a mega, semi-mega camp,
Conference.
branch organization program, sir.
My pleasure
Definitely.
to be associated with all the branches.
It is your wish, sir, definitely. And we never forget your orientation program that conducted at Kochi. Really very fantastic organization, sir. I think other members, if any member want any doubt, please raise their hands and ask the sir.
You can either ask or put it in the chat box also.
Yes, yes, yes. Just I will give 5 minutes time, sir, for any person.
Yeah, no issues. We stopped early, no?
The question actually. Regarding stock audit, I worked in a public organization, public sector, sir. So
Yeah.
I had an experience in actually filtrage and that leakage and sometimes evaporation and grammatical value
Certainly.
observation.
No,
These are the
some public sector practices are very good, sir, to be imbibed by
yes,
private sector.
we had a excellent teamwork, sir. When we had a means, of course, statutory auditors will definitely ask the stock valuation reports, and we will cooperate with that. And we are having our team, excellent team, so that they cannot point out any of the mistakes from the stock statements. That is what we have done in our area, sir. Thank you, sir.
And appreciate, sir.
Uh,
My father was also a public sector person. He was a SAIL, Steel Authority of India Limited. He joined when it was Hindustan Steel Limited.
I am from Coal India, sir.
And then he retired from Cochin Shipyard as the General Manager of Finance. He was a first generation cost accountant. He's no more, but he was inspiration for me to become a chartered accountant. And but we could not work together. But he retired and then he joined the practice.
Very nice, sir. Very nice in hearing your father, so these things, sir. I am from Coal India, sir, actually. I worked as a company secretary also in that area.
Oh, I see. Coal India went for a huge IPO. So all these things I'm saying will be very small for you.
Yeah, we worked in that area, sir.
Great,
And
great.
subsidiaries.
I think there's a
well
call shortage now, sir. Apart from this, I think huge call shortage is anticipated.
Yeah. So stock pilferage is there. Sometimes fair will be also happens, and stock will definitely reduce with that. We are having some technicals, metric analysis, some like that is there. Square meters and how much coolies will be there. That these types of techniques we are using, and we have done in that way, sir.
They call macro measurement
Yes,
ways of doing it, because you cannot go and weigh and
we
count the
cannot.
number of sacks and all. It doesn't work. Yeah, I
We
understand.
cannot see see the huge hills of the coal. We cannot measure in that way, so we can have
Accounting is all about estimations. It should be reasonable. That's all.
diameter wise we can measure in that way, sir. And especially this oil leakages and these are some techniques actually we can learn from the public sector sites only. These things. Thank you, sir. Thank you very much for enlightening all the new things for new development of the CARO. Now I request our West Godavari branch chairman, Ravi Kiran, sir, please say a vote of thanks on this occasion. Thank you, sir.
Good evening, sir. Sir, Jai sir, when I am seeing already last time also you met in the webinar, sir, for Godavari districts.
Yes.
3 branches were conducted, sir. I remember on that. But
I do.
For 1 year, at least 1 or 2 programs with you, sir. Actually,
I'll come physically, sir. What is there? Don't confine to online.
Yes, sir. That's sir. 1 or 2 programs. Actually, we want to conduct with you, sir. So, thank you very much, sir. Webinar will come to the end. So, I would like to thank to our chief guest of D. Prasanna Kumar because he is not able to come because of the meeting. And the guest of honor, Naresh Chandragalli garu and Mappal Subbarao garu, RCM and ex-officio of Rajahmundry and West Godavari branches. And very valuable time, precious time. I would like to thank to our speaker of the day of CA.Jomon garu, past chairman and of SILC, for enlightening us for more about CARO-2020. For giving great information. I would like to thank to each and every participant of the 2 branches chairmen and all the members of the 3 branches, members and committee members. Thanks to everybody, sir. Thank you for giving the opportunity. And always, when you are seeing, always remembering for orientation program at Kochi.
My pleasure to host you anytime.
Very great moment, sir.
Whether I'm chairman or not.
Yeah.
Come to Kerala.
Yes,
When you go to
sir.
Sabrimala, drop in at least on your way back. Spend 2 days in Kochi. I'll be only happy to host you.
Okay, definitely. Sir.
Ravikiran, 1 minute, please. Ravikiran, please, sir. There is one question from Pancham, sir. Is also asking one question. Actually, he is in the chat box.
Sir, hello, sir.
Yeah, yes, sir.
Sir, this is not related to this topic. This one in MSME, if the company failed to pay to the payments to the MSME creditors, it has to make a provision 3 times of the repo rate in monthly compounding.
Yes.
Is there any how to escape that thing? Is there any exception to this?
No exception, sir. MSME Act is very clear. 2003, Act is very clear. And that has been that is being enforced to make sure that all these smaller players are not, taken undue credit by large corporates. But many of the corporates are not they are not able to identify. One reason is that whether that's an MSME or not. But I think as in the Schedule 3, revised Schedule 3, there's a requirement to give the creditors, MSMEs and other creditors separate. Companies will need to do some research on whether MSME or not. If there are overdues to MSMEs, they should avoid delays. If there are delays, then this 3 times that will be triggered, and that will have to, if the amount is substantial, that will have to be provided first with a note.
And the same to be disallowed while computing that income tax return, na?
Income tax man will not allow unless it is paid.
Unless it is paid.
Yeah. If it is paid at that point of time, yes, you can. Then he would also say that it is capital expenditure, but I'm not a tax person. You'll have to ask a tax expert.
Yes, sir. Okay, sir.
Please continue, sir. Please continue.
So once again, thank you, sir. Thank you very much for all the 3 committee members and all the CA members of the 3 branches. Sir. Thank you very much.
Again, we'll meet on 4th, Ravikiran?
Yes, sir.
4th, again, we are meeting on same webinar?
Yes, sir. Yes, sir.
Yeah.
Okay, sir.
Thank you so much, sir. Thank you all of you. Thank you very much. Have a great evening.
Yeah. Thank you very much, sir. Thank you.
Thank you very much, sir. Thank you very much, sir, for giving us the time to go.